Will housing affordability ever change?
In today's video, we're going to go over an article from stories.com from a Desjardins representative talking about if housing affordability will ever reach the pre-pandemic levels. My name is Mike Carpino. If you're interested in talking real estate with me one-on-one beyond this article, don't hesitate. Click that first link in the description box down below. We can chat about whatever it is you want to talk about in the real estate market. You can either reach out to me through the contact information in the first comment below, or book a 30-minute consultation. We can have a chat, figure out if there's any assistance that I can give you in the market. So let's get into the article and we'll break it down once we finish up here, and I'll give you my full opinion. So housing affordability will improve, but won't soon reach pre-pandemic levels. This is from Desjardins once again. So according to a new report from Desjardins, some prospective buyers may find opportunities in late 2024 and early 2025. So in the next 6 to 10 months, potentially, there might be some opportunities. At least that's what we're being hinted at. So with the Bank of Canada finally making a rate cut last month, the first one in over 4 years, I mind you, Canada's realtors are saying that the country's buyers are slowly, which is the key word of course here, coming off of the sidelines with further rate cuts projected for 2024. The big question of course still does remain, when's a good time to buy? And this is my favorite question I get from every single buyer out there. With home prices expected to rise as rates fall, there will be a sweet spot for prospective buyers to jump into the housing market. Of course, there will. According to a news report from Desjardins, some prospective buyers may find opportunities in late 2024 and early 2025 as interest rates potentially continue to drop. With several caveats and additional considerations, more on those later in the article, the new modeling is based on the Desjardins Affordability Index, they're calling it the DAI, which considers factors like mortgage qualification threshold, disposable income, home prices, ownership costs, and mortgage rates in measure of affordability. So the Canada's housing affordability will improve according to the report, albeit slowly, and won't return to pre-pandemic levels for at least 2 more years. How do they know that? I'm not quite sure, but it's part of their model. And it's partially because there's multiple drivers of affordability, not just real estate prices. In the report, the lower interest rates will reduce the cost of carrying mortgage debt, but they will also put some upward pressure on homes by extension of monthly mortgage payments. So what they mean here is, as you start to see mortgage payments lower, it makes a lot of sense that prices may slightly rise because you get more people who are feeling the need to get into the real estate market when the prices, or when their monthly payments rather, become more affordable. This, of course, is in contrast to what we've seen in the market from coast to coast for the past 2 years, when prices stalled or fell, but sky-high interest rates negatively have impacted the affordability. And with that said, Canadians shouldn't get their hopes up that borrowing rates return to rock bottom levels. I'm going to stop reading it right there. We are not going to have rates in the 1% to 2% range for quite some time, if not ever again, especially with the issues that we are now seeing in our market. Back to the article. Canadians should not get their hopes up that the borrowing rates return to rock bottom levels seen at times during the past decade. Moreover, income growth will be muted in the coming quarters as the Canadian economy slows. And the end result of gradually improving housing affordability, however, holds true under all 4 of the alternative forecast scenarios that are explored in the report. Those being an extension of mortgage repayment times, changes in temporary migration policy, and a pronounced spike in new listings, and a recession. Interesting, eh? Naturally and unsurprisingly, highlights that regional differences will persist. Of course, from region to region, we can't say it's going to be the same across the board. In the notoriously expensive housing market of Ontario and BC, costly starting points means that they'll likely remain the most expensive 2 markets, while Alberta should remain the most affordable. Since pandemic, affordability has deteriorated less in Ontario and BC than elsewhere in Canada, but that's largely because they were already unaffordable and they had less room to run, writes Demereau. We think these jurisdictions, particularly costly starting points, means that they'll remain most prohibitively expensive. By contrast, the cost of home ownership should remain relatively low in Quebec, Alberta, despite the more pronounced erosion of affordability since 2019. And back to those caveats, when it comes to timing the market, or at least trying to time the market, the reminder is that the decision to purchase a home is specific to an individual, and it should reflect your own financial situation. Our projections obviously don't explicitly incorporate sentimental effect that could occur if, say, the rate drifts lower than anticipated in the future, central bank rate cuts, and drive outsized buyer exuberance. Opportunities may differ for apartments and detached homes or between cities and neighborhoods, but that some prospective buyers will need to find opportunities by the end of the year and in the early months of next year. And by that point, they anticipate that the national DAI will have climbed about 4 to 5 percentage points from its current level, which is about 2/3 of the affordability improvement expected by the end of 2025. And as we finish off here, optimistically, for those who are looking to seek building wealth in the housing market, our projections also include a steady price gain beyond that point as rate cuts completed earlier increasingly work their way through the Canadian economy. He concludes by saying that increasingly the country's housing supply is the only sustainable long-term solution. In the meantime, all eyes are on the Bank of Canada once again, as they have been for quite some time, on July 24th, where we have another rate announcement that we'll see what happens. So what does all of this mean? Once again, you're getting an analyst who's just got an opinion. There's nothing definitive here. They have their models, and of course, some of them might end up being right, some of them might end up being wrong, all of them might end up being right, or maybe all of them are going to end up being wrong. Let's just be frank. We don't know for certain. There's a lot of different factors. So this article really does pinpoint on the importance of where do you live? Do you live in the Greater Toronto Area? Do you live in BC? These two markets are already nuts in terms of your price. So the fact that they potentially could scale back a little bit is great, but you have to understand where they're at and where they will go. It's not like they're going to cut in half. You might see a little bit of a scale back in some areas, but ultimately you have to remember, Ontario and BC, they also have a lot of immigration. They have a lot of buyers. And if prices scale back, it's more likely that these two provinces have more people hop back into the market again and even just stabilize things. So the likelihood that we're going to see a massive difference in the price is pretty low in my opinion. However, the biggest caveat I think is mortgage renewals. We've talked about it several times on this channel, and if you're not subscribed, click the subscribe button. You're going to get some repetitive information in terms of ideas on what's going to happen in the future, but I'm persistent with my ideas. And mortgage renewals, among a lot of other things, but mortgage renewals is very interesting. In 2025 and 2026, a lot of people who've purchased homes 3 to 5 years ago with lower fixed rates, fixed being the key term, because we're talking Bank of Canada all the time, but that is a variable rate. They are changing the variable only. If you're fixed, nobody's had to suffer yet. In 2025 and 2026, people will suffer if the rates are not substantially different than they are today. People are locked in under 2% for a fixed 5-year. And for them to have to potentially double their payment to go to a 4.5% or a 4% fixed, that is where the issue is going to lie. Can that person still afford their home in the future when it comes to the renewal? They don't have to worry about the qualifications again. That mortgage is still there for them. But can you afford to spend another $1,000 a month on your mortgage? $2,000 a month on your mortgage? We don't know. We don't know how large some of these mortgages people are holding are. The average mortgage out there, I'd say, is between $500,000 and $600,000. But if you've locked in at 2.5%, you're going to see probably about $1,500 increase minimum on your next mortgage renewal if you want to go the fixed route. And obviously variable, it might be more if you go that route. I think that is the opportunity wherein lies a lot of buyers on the sidelines to get into the market when those people need to sell their homes or when we have a potential drop in price at that point. Let me know what you think in the comment section down below. Do you think the mortgage rate renewal is the biggest issue coming up? Do you think that the Desjardins article here is pretty accurate and that we might actually see some stability, maybe some potential growth and some opportunity for buyers in the real estate market? Let me know your thoughts. Obviously, this is just one real estate agent's opinion in the Greater Toronto area, but if you trust my opinion and you like the analysis, like the video, put a comment in the comment section down below, and I'll see you in the next one. Bye for now.